Okay, so this is Chapter 4, Part 2, and I left off talking a little bit about internal rate of return. This is something else that you should have learned from finance class when we did time value of money. Internal rate of return is a measurement of a percentile return of having your investment and then reinvesting the money your investment generates. So as a return mechanism, it's good because it uses time value of money, allows for investments to be calculated over different periods and to be compared with each other. So you could look at 2 different or 3 or 10 different investments over a period of time. So you could say, from a corporate point of view, you may look at 5 different companies to buy. So Facebook could look at WhatsApp and buy that for $19 million, or they could have bought Ford Motor Company and had change over to buy Yelp or something. I don't know. But you'd want to look at, well, what are the returns of each of these, 3 or 4 or 5 different investments? Is Facebook likely to get a significant return from WhatsApp compared to the $19 billion they invested in it? I do remember there was a point in time when Google paid a huge amount of money for YouTube, and people questioned if that investment would pay off, and it actually did pay off. So sometimes when they pay huge amounts of money for these companies on the internet, you kind of think, well, that doesn't make any sense. Sometimes the companies can actually turn it into a much bigger website and make a lot more money from it. So I guess with YouTube, when Google bought it, they turned it into this mega franchise that they were able to make a huge amount of profits from it. Same thing when eBay bought PayPal. They were able to leverage it up greatly. But all these companies, one aspect that they have in common is they did use internal rate of return to look at the money they're paying for the investment and then what they project will be the future revenues as they grow the investment. And it's a rather complex calculation to make. That's sort of a disadvantage of it. You need a spreadsheet, you need a lot of data, you have to get all the cash flows and make predictions on forecasts and really kind of predict where the sales and profits are going 5-10 years in the future. And then you could calculate an actual percentage return on the money you invest inside of the company. So if Facebook buys WhatsApp for $19 billion, Facebook's paying for that company with invested capital in Facebook. So the money that they issued when Facebook went public, they issued stock, plus the money they generate, maybe some money they borrow is going to be the capital they invest in WhatsApp. So WhatsApp has to make a return to cover the cost of those investments. An internal rate of return helps to show that. All right. Here is, you could use internal rate of return on multiple different types of investments, bonds, stocks, anything that has a stream of income. And what we look at is, generally what we want to look at is a time frame. So here we have 7 years as part of the time frame. We have the net income for each year, and for each year we have to discount that net income because the net income we receive today is much, dollar per dollar is much more valuable than what we receive in 7 years. Especially when you're talking about a high percentage of capital cost. Here we have a 9%. So when we're looking at discounting at 9%, $1,200 in year 7 is only really worth about $656 in present value terms. So if we're looking at 2 different projects here, let's see, or 2 different rates. Here we go. This project's valued at a rate of 9%, and this project's valued at a rate of 10%. You can see that if you're looking at a 10% rate, you have less money on the same income. You're going to have $1,117 at a discount rate of 9%, but you're only going to have $1,063 on a discount rate of 10%. So your cost of capital is key. It's a basic principle, common sense. You don't borrow a cash advance from your credit card at 22% interest to put into a treasury bill earning 2% interest. And that's what internal rate of return helps show. If I'm going to invest a lot of money inside of a company and I'm going to have a particular rate of the capital I'm investing, I'm going to need that to discount it by the cash flows to see if this is really generating more wealth than the cost of the capital used to make the project. In the stock world, if you're going to invest in a bond or a stock that pays a dividend, but more specifically, if you're going to invest in a bond, you want to make sure that to calculate what your rate of return is going to be over a period of time. And internal rate of return helps to do that, but it does it with applying time value of money so that the actual return is realistic into today's dollars. So you could say that I'm going to buy this stock and it has a 3% dividend. You know, after 10 years, what's today's value of those dividends discounted to today's dollars? You know, it could be $30 a year for 10 years. So you say, oh, 300. You take the time value of money, you discount it for the cost of investing in that stock. It may only be worth $220. So it's a more realistic look at your returns. And this can easily be done in a spreadsheet. So if you have, if you're using Excel, you can create a formula in Excel, and they do show the formula at the bottom down here. You just have to type equals IRR and then highlight the column of numbers, and it'll come up with automatically calculate the internal rate of return. So that's how nobody does it by hand. They use either a financial calculator or a spreadsheet to calculate this as a method of return. Now, one critical area is that the internal rate of return assumes that whatever money you make, whatever dividends you make from the stock or bond, you're reinvesting in that same bond and going to have the same rate of return. So if it's a 10% paying bond, you make $100 that first year, you reinvest it and buy more of that bond. So it's assuming that whatever money that you earn, you reinvest at the same rate. So that way, they do have a modified investment rate of return if you have a project that's going to yield uneven rates of return. But that's a little out of scope for this lecture. So the reinvestment rate is going to be whatever percentage return you're going to get from the investment that you're going to reinvest in the investment. And that's sort of just the compounding money philosophy. My bank account makes $100, and next year, because I have the $100 in the account, I make $110, and then it keeps growing. You get interest on the interest. And that would be your compound rate. So you'll have one rate, which is the rate that the bond pays. You say it's 10%, but you may have a compound return from the interest you earn on your interest, which will be higher. All right. So let's just look at this chart right here, and we'll see that what if we made an investment at an 8% rate of return versus a 5% rate of return versus a 0% rate of return? The red line would be 0. So your parents are going to lend you $1,000 that you can pay back to them in 20 years. So for them, or maybe you lend somebody $1,000 and they'll pay you back in 20 years. So you get $1,000 you lend today, and in 20 years you recover $1,000. You could see that in 20 years $1,000 isn't worth what it's worth today. Go back 20 years from today and compare prices on things. You can see how inflation eats away at, if you look at gasoline, where right now we're fluctuating between $3.50 and $4 a gallon. Back in the 90s, early 90s, gas was under $2 a gallon. So you can see how it erodes the money. So that's why you want to return higher than that 3% average inflation. And at 5%, your $1,000 turns into $2,600 rather. And at 8%, your investment returns $4,661. So that's how starting out with the same point, no interest, you end up with $1,000. And as you keep increasing interest, you make more and more money. So you always want to take the time to find the investments, the bonds, the stocks that are going to return the most to you. Now, we don't think of stocks as returning an interest to us like a bond, but stocks have a dividend yield, which is like a return of a percentage. And many stocks have a dividend yield higher than treasuries, higher than 2%. And if you look at, you can consider, I guess, the gains in stock price as a gain or as a return at the end of it. So that's why we invest in stocks, because of all the investments, stocks the only investment that continually beats inflation over a longer period of horizon. So you can have individual years where stocks go down and they don't beat inflation, but over time it's going to beat inflation. And if you had your money invested in stocks 5 years ago, you would have probably had 100% return on that money since then. All right. All right, so we can use something called, if we want to find a growth rate, and this, you may have solved for K in your time value of money work. I know we did that in my class. And it's really just trying to figure out what's the rate of growth, the compound annual rate of change in the income you're receiving from your investments. And it really gives us an idea how quickly our money is growing. So when it comes to stocks, it's not so easy. You really have to you calculate this based on capital gains and dividends as a stream of income. Now, if you have a financial calculator, these slides will show you some of the basic functionality to use with a financial calculator, but I don't expect you to do that. Most of the work should be done in Excel. Financial calculators are very old school, and very few people use them these days, because before there were phones with apps and phones capable, or tablets you can use Excel on, people had to rely on these financial calculators to do calculations on the fly and in the field. But today we have generally easy access to spreadsheets anywhere we go. And here there's a rate formula where you can put in the years from 2002 to 2001 in the first part. So it would basically calculate the number of years. And then in the second part, we could put in the stream of dividends from B3 to B12. And we can calculate an expression that's going to give us an annual growth rate. So even though, so the dividends, you see how each year the dividends are increasing. And that's what investors like. If you're investing in a dividend-oriented stock, you're not investing in that stock for capital gains. You don't expect the stock price to go up. What you expect is a steady stream of dividends and an increasing stream of dividends. Like a utility is a good example. A strong utility that has a rate of growth because of population increase, or the increase in the amount of energy we use. I mean, today, and just think about a household today uses a terrific amount of more energy, even with the more efficient appliances than a household previously. And one big reason for that is computers. So you have, previously, when I was younger, a household would have one TV set, no dishwasher, would have a washing machine, but you dry your clothes outside on the clothes hanger with clothes hanging pins. Ever see this in a movie maybe? You may wonder, why do they put their sheets outside and their clothes outside? That's to dry them. It was their original wind energy, alternative energy, to dry your clothes. Now today, everybody in the house has their own TV and computer, and they're both on at the same time while you're on your tablet. So, right, you're guilty of this. You turn your computer on, you leave it on all day. Sometimes a couple days in a row, and that sucks up power. Even your TV, it's not on, the TV's using power. So that's just an example of how utilities are continually being able to grow their dividends, meanwhile their stock price doesn't move up too much. So if we wanted to get an annualized growth rate over these 10 years, we can do an annual growth rate formula easily in Excel. And that I would encourage that if you're doing any of your homeworks, to try to incorporate Excel. You could utilize it through the spreadsheets that I have on Blackboard under course handouts, or you could just work with it yourself and type out the problem as shown. The textbook also has additional information on Excel and formulas to use for some of the various problems. Okay, so let's talk about sources of risk. And this is a big topic for this chapter. Now, investing is all about the risk-return trade-off. There's a relationship between risk and return, in which investments with more risk should provide higher returns. And investments with less risk will generally return less. So if you're going to, the only reason to invest in a risky stock, say like Yelp or Open or Zynga or Pandora is a stock. Anybody use Pandora? Um, See, I would be worried about Facebook. I think that's a particularly risky stock because I feel like most people have stopped using Facebook. And the people who matter, not us, the people under 30. You may be under 30. I don't want to judge you, but I'm not. I'm over 30. But the people under 30, which is the majority of this class, you've stopped using Facebook. And or you don't use Facebook as much. Or you've automated Facebook where your Tumblr, your Twitter, what other social media accounts you have, you make a message on these and automatically update your Facebook, but you never look at Facebook. And that's because your grandparents are on Facebook now, your parents are on Facebook. Potential employers will be looking at your Facebook before they hire you. So you want to craft a very up straight and a very unique image of yourself on Facebook because all these people are watching you now. So that doesn't, for me, I don't see a lot of growth in Facebook. If the crowd that really heavily used it hours a day is moving over to Tumblr and Twitter and Snapchat or whatever, Instagram, so there's a lot more competition. So I would think Facebook, I would need a very high return for me to invest in Facebook because of this risk. And there's also the risk that someone can make a competing platform that's more attractive, has better features, better integration, and because these internet social media sites are continually evolving, adapting, and new sites are growing, and young people are quick to adapt and incorporate them. And that's, I think, the only growth in Facebook is that some of the older generations who finally figured out Facebook and got on Facebook aren't likely to go and seek out another platform too quickly. Now, so if we look at risk, though, that's the actual return we're going to get from the investment. And it definitely, most of the time, will be different than what we expect. So the return that we want based on the risk doesn't always materialize. That's why we have to analyze the stocks to figure out if we're going to get a return equal to the risk of investing in this company. And the number one reason for poor returns in the stock market is underestimating the risk or the return of a company. The more we know about a company, the more we understand the risk and the return, the more accurately priced the company is going to be. When we don't really understand a company or its functionality or the risks involved, the price of stock will be inaccurate, sometimes overvalued, sometimes undervalued. So very simplistic type of business that we can understand, say like Geico, they issue insurance for motor vehicles and they make money based on, what they pay out on accidents versus your premium. A Geico is a business you can understand because what does Geico do when they start paying out more insurance returns to people of car accidents? They raise your rates, even though you didn't have an accident. They raise everyone's rates. So it's a guaranteed profit for this company. Geico can't lose money because if they look like they're starting to lose money, they just raise everyone's rates. They'll raise everyone's rates anyway because insurance, that's why there's a lot of switching of car insurance because they like to lower your entry rate. So they can steal you away from Geico and give you $200-300 less annual cost of your insurance, but they'll slowly keep creeping it up till you get to a point where every 5 years or so you have to jump ship and go to another insurance company to get a lower rate. Okay, so let's talk about business risk. This is the risk associated with the ability of the investors, the business to pay returns to investors. So a business risk is going to affect anybody who's invested in that business. Most vulnerable are the common stockholders because if a company has a degree of uncertainty, they're the ones who stand to lose the most in that investment. So businesses, they change all the time. Sometimes they become more popular, make more profits, gain more market share, or sometimes businesses make bad decisions and start to decline. Before Facebook, there was MySpace, and they made a lot of bad decisions, like selling out and aggressively advertising and having creating I guess, an unfriendly, unintuitive interface, and then, you know, just the slowness of the system really killed it, and the uncoolness of the system once a corporation, big corporation, purchased them and started to leverage them. It just became a site where people moved on away from. And before MySpace, there was a social media company called Friendster. Does anybody remember Friendster? And that was big, but that got slow because too many people joined up too quickly. They didn't invest enough on their infrastructure. They made bad management decisions. They didn't invest enough to expand their servers and their response time, and it got very slow. And that's why everybody moved over to MySpace. And then when MySpace became very annoying and everybody had an account on it, it was just, you know, people looked for the next cool thing. And Facebook delivered the next cool thing. Why was it so cool? Because only college students can use it. At one point, Facebook was just .edu. And you couldn't get into it unless you had a .edu account, and it was only college students, so it seemed really cool. And then when they opened it up to everybody, it became exceptionally less cool. See what's that movie, Social Media? Social Network. See that movie if you want more explanation on that. Sometimes you see Mark Zuckerberg's face and you just want to punch it. You know, do you feel like that too? You just want to punch that guy in the face. I hate how smug and arrogant he is now, like, oh, I'm worth billions. Like, he has every right to be, but I don't like that, rubbing that in my face all the time. Every time I see him, I think he's rubbing it in. Oh, I'm giving my money away. I'm so rich now. And, you know, this is what happens when people get too wealthy. They lose touch. And they don't understand what's cool anymore, or what the day-to-day person really is going through. And then once they lose touch of that, then their decision of the companies can never be as good. That was one thing that was really good about Steve Jobs, is that even though he was an egomaniac, and he still was humble enough to create things that everybody could use and need. Do you know that he lived in a pretty ordinary house? His house was not a mansion like Bill Gates with 57 bedrooms, or you ever see his house? I saw it in 60 Minutes. You would never guess he lived there. It just looked like, you know, it was upper scale, but it was just like a house with maybe 4 or 5 bedrooms, just nothing, no gate around it. And I think that's one of the reasons that he was able to craft so many good products, is that he really was in touch with what people needed and wanted, and the struggles of everyday life, where most people, when they get elevated above that status, they really lose touch. All right. Okay. If we're going to talk about financial risk, it's different than business risk. Business risk is specifically associated with the ability of the company to remain in business, and that their business model is something that customers want to purchase and take part of, and that they can do it profitably. So it's really, business risk is all about running the business or having a good operation. Financial risk is the risk of the company not being able to pay its bills. And the difference is, you could have an operation that's a solid operation that will make money. However, they borrowed so much money that they can't make enough profits from their operation to pay the debt. So you could have a company that's, I'll give you an example. This is a long time ago. Do you know a fast food restaurant called Boston Market? Okay. Before it was Boston Market, it was Boston Chicken. And Boston Chicken was a very hot stock, and it went from pennies to, say, you could have bought it for 50 cents or $1 to $35 to $60 a share, and the store expanded greatly, and restaurants were popping up everywhere, and they were borrowing money, and they were opening up new franchises everywhere, and they just got ahead of themselves. It was a good business model. The stores were busy, and they made money. The operations were good, but they borrowed too aggressively and at too high of a cost, and they went bankrupt. So what happened? McDonald's swooped in, purchased them, and originally McDonald's purchased them just to get the real estate, and then they just left it alone as Boston Market when they realized they didn't need any more McDonald's to be open, so they left it alone as Boston Market, but they didn't expand them. When's the last time you've seen a new Boston Market being built? It's pretty much the locations that existed, they just maintained them, and eventually they sold it back to private equity once the company became solvent again and was able to pay back all their loans and debt. So the business was fine. It was just that the financial risk became too great because they borrowed too much money. Say a more up-to-date example. Let me give you an up-to-date example. Hostess, when that went bankrupt, it had a great operation. Twinkies and Wonder Bread and so many products that they made that we love and that sell very well. They went bankrupt because of the debt and labor costs, things they weren't able to manage. So they had their financial risk. They weren't able to pay their debt off, and they went bankrupt. But the company itself is a profitable operation, and the pieces of the company were purchased by other businesses that today run it very profitably and make their Twinkies at a very profitable rate. You'll notice today, you may not notice, but I have noticed that the Twinkies are a lot smaller today than when I was a kid. Or maybe I've gotten a lot bigger and they look a lot smaller to me, but everything today is a lot smaller compared to the sizes in the stores. And that's just one way companies manage their risk. That if a package of Oreo cookies today is about 33% less cookies than it was 10 years ago. And what they've done is they reshaped the interior of the packaging to hold less cookies, and also the sizing of the package. And it's the same price though. So to you as a consumer, it seems like the price never went up, but since they're giving you a third less product, they're making more profits. And the business is stable, they're making more income, and their financial risk is lower. But you as a consumer would rarely even notice that, your paper towels have less sheets in them, that your peanut butter has less ounces, and your ice cream pints are no longer pints, except for Ben & Jerry's that print on the label still a pint. And the reason they say still a pint is because Haagen-Dazs and all the other companies had just made, it looks like a pint, but they've made it smaller, put less ice cream in there. And it's just a way for companies to maintain their profitability. So if you're looking at, when we're talking about companies, they sometimes will disappoint. They could disappoint in what your overall expectations are, but they do that to maintain their profits, to maintain their business and manage their business and financial risk. So sometimes, hopefully they can do it in a way that you don't notice. Reduce costs on certain packaging, certain materials, certain ingredients, or the amount of size. One thing this is an older example, to improve their business and lower their business and lower their financial risk. A whole host of beverage companies substituted sugar for high fructose corn syrup. And the first one, I believe, was Ocean Spray, their cranberry juices. They took out sugar and put in high fructose corn syrup because it was so much cheaper, because corn is subsidized by the U.S. government. The U.S. government subsidizes corn a great deal, so high fructose corn syrup, which was a processed derivative of corn, taking the fructose out of it and processing it, making it concentrated so it's very sweet, was cheaper than sugar, cane sugar. Although years later, now you're seeing the opposite. You're seeing no high fructose corn syrup on packaging. Have you seen that? Because they value, they're willing to absorb the extra cost of the cane sugar over the high fructose corn syrup because they can boost sales. Because now you feel like this product is healthier. And some research has shown that cane sugar is healthier for your body than high fructose Frankenstein sugar that they put in, which is still in many sodas, most sodas. But they do it not because they do it because it's going to improve profits. Why do they want to improve profits? Because they want to show a lower business and financial risk so the stock price goes up, so shareholders maximize, their wealth is maximized. Today it's getting harder and harder for businesses to get away with things like that because consumers are more aware of what the nutrition labels are or what the content is. And, then there's a whole revolution in restaurants where there was a significant risk when restaurants were asked to display their menu items and give you the calorie count and the fat grams and basic nutritional information on menus. And suddenly industries were scrambling to develop these new lower calorie menu items, because before, if you didn't see what the calorie count was, everyone was happy. The taste, you can easily make something taste great by piling in more fat and sugar in it. More carbs and fat and sugar, and it'll taste great. More oil, more frying, and we'll love it. But if you suddenly know that this one dessert or this meal is 1,500 calories, the appetizer, the meal, and dessert together are 5,000 calories, then you're a little bit less likely to order the appetizer or dessert. So now this was a significant risk for restaurants, and a lot of these restaurants stock prices have went down in anticipation of a potential risk of people wanting to eat out less once they realized how bad some of these menu options were. Okay. Another source of risk is purchasing power risk, and this is basically inflation. So it's a chance in the change in the level of prices. Now it could be inflation or deflation, but deflation is very rare, especially when countries around the world are printing so much money. Inflation is going to be more common than deflation. They consider deflation more destructive to an economy than inflation. They consider a small amount of inflation actually good for the overall economy, and deflation to be very destructive. So as far as an investor, you got to worry about both of these, but most likely the inflation, because it's going to eat away at your returns. Now, as far as a company, they're worried about prices going up on the materials they buy, because that's going to eat into their profits. And that's actually would be held under the business risk. But for us as an investor, the increase in prices is going to lower overall returns. So we don't want to put money in banks anymore because we don't want to get a 0.25% interest rate because we're not getting any return. The only reason to have money in a bank is so you can maintain a checking account or a debit card or things like that, or pay bills through it, because the return is just so low. And if they can't beat inflation, the investment isn't worth it. So the higher inflation goes, the higher return you're going to need on your investments, as we saw from that risk premium that we're calculating early as an example. Now, interest rate risk is generally tied to inflation, because if inflation goes up, the Fed raises interest rates. So interest rate risk is going to definitely affect, most specifically, bonds is going to be affected the most immediately. So if interest rates go up, bond prices go down. The yields are fixed. So a 10% yield is a 10% yield on a fixed bond. So the yield isn't going to change. You're still going to get a 10% rate. However, if you bought that bond at $1,000 at a 10% rate and interest rates go to 20%, who's going to want your old stinky bond at 10%? So the price of your bond is going to have to lower to a point where the 10% yield on the $1,000 becomes 20%. So it's going to have to lower to $500. So the $100 yield is now a 20% yield. So it's comparable to the new bonds. So interest rate increases in interest rates will really destroy the value of the bond asset. Eventually, it's going to affect stocks too, because interest rates go up, it becomes more costly to borrow money, and that's going to eat into profits, and eventually stocks will go down. And that's one reason that the Fed raises interest rates, is to cool off the economy. So if they feel the economy is too red hot and inflation is preferable over an overheated economy, so they rather have a recession and low inflation than an expansion and high inflation. So they'll raise interest rates to cool the economy down so that inflation will ratchet down, and then they'll lower interest rates once inflation is under control. And the worst example of this was in the early 80s when inflation was double-digit percentages in the teens, and they raised interest rates to combat the inflation, and it worked. But the result was a very devastating recession. Not as bad as the Great Recession we just went through, but they had a recession. But it was needed to rebalance and to reduce inflation. All right. So liquidity is also another big risk for investors. And this is really how quickly you can turn your investment into cash. So if you're investing in real estate is sort of like a turtle of most investment classes. It used to be thought that real estate always goes up, but it's just going to go up slowly and consistently. And then, unless you have a real estate bubble, which the United States experienced in 2000 to 2007, and China is experiencing right now. And if real estate's increasing at greater than 5 to 10 or between 5 to 10% a year, that's a bubble phase. But the problem with real estate is when the prices start going down, it's very difficult to sell, and it sort of generates more declines in prices. So just think of it. You want to sell your house and lock in your profits. You're willing, you maybe could get 400,000 for it, but you're willing to take 350,000 just to sell now and get out because things are going. There's less demand and less buyers and less people interested. So this liquidity, that's one great thing about stocks. You can convert your stock into cash relatively quickly. But things like real estate, it's going to take a lot longer. So there's a lot more risk involved in tying that money up. So if you want to, the less liquid an asset is, the more you have to discount it to sell it quickly. So for houses, that's why housing prices went down so fast when the bubble burst and the housing prices were going down. They went down in some areas very significantly because people had to get out. They had to, they wanted to get out before prices went down even more. So now it's a race to the bottom. Luckily, the housing market has leveled off and prices have started going back up again for the basic fact that people need housing. So there's always, if the population is growing, there's going to be an increasing amount of demand for houses, and that's good for the economy because it's good for resale, which gives individual people more profits when they sell their home, and it's good for construction of new homes. And that's why recently, last week, they were looking at new housing starts as an indicator of the stock market, and when that was a little disappointing, they blamed it on the weather. So we'll see what happens. If that happens in the spring, they won't have the weather to blame it on, and that could be an issue. But generally, stocks and bonds are pretty liquid. But there are some stocks that aren't as liquid. They don't trade as much. There's not that much volume on them. And if you try to sell out quickly, the price will go down much faster than stocks with more liquidity. Okay. And then, of course, we have the tax risk. And this is a risk that, Congress could change the tax laws, driving down the returns of your long-term investments, your dividends. Dividends are taxed at a different rate than regular income. Long-term investments are taxed at a different rate than income. Municipal bonds, and even real estate tax. Real estate income capital. You know what's great about real estate? You buy a house, and you sell a house at a profit, and you don't pay any tax on that money. There are some stipulations and time frames in there, but for the most part, you buy a house, hold it for a number of years, and eventually sell it at a profit, and no taxes have to be paid. That's pretty great. Not the same for stocks though. But the laws could change, and they could say if you make a profit on your primary home, then you have to pay your income tax on that. And that could, if you make a $100,000 profit, which is easy for a lot of property, especially lived in for 10 years, now $35,000 is going to go to the government. So a significant change or risk if they change the tax laws. And recently they did change the tax laws, and they increased the amount of brackets at the higher end. And they always have this other weird tax called the ATM tax, alternative minimum tax, that if you live in New York State, you may be subject to this. If you have pay a lot of state tax or pay a lot of property tax, you get to a certain threshold, and they're just not going to allow it as a deduction. So there are, and that changes. Those types of tax laws can change pretty quickly. For example, if the government switches over to primarily Republicans, they may repeal a good number of taxes. For example, the last Republican we had was George Bush, and when he came into office, we had over $1 trillion surplus, and he quickly sent everybody a $200 check and cut a bunch of tax brackets and corporate taxes. And that was good, except for the fact that the money he was cutting in taxes, coupled with a recession, led to budget deficits and an increasing deficit that was continued through Obama's presidency as well. And now we're at, I don't know, 14 trillion or plus, maybe 17 trillion. I can't keep track of it. Could be 20 trillion by the time tomorrow. And it's just insane. And so taxes in the future most likely will have to go up to pay for this. You can't borrow forever. At some point, taxes will have to be increased to help pay part of this back at least. Either that or we just cancel Social Security completely. Just say that won't even pay for everything, but it's a start. I'm not suggesting, I'm not in favor of that, but it could happen in your lifetime where they just say, listen, if you want Social Security, you have to reach age 90 before you can receive it. Event risk. This is something unpredictable, a type of risk that can happen to any company at any time. If I was to tell you there might be an earthquake in California in April, and say I knew for certain there's definitely going to be a big earthquake in San Francisco in April, you may want to rethink your investments in any companies that are located solely in San Francisco, because that's going to have a significant impact on their operations. However, event risk is random, and you really don't know where the next earthquake or tsunami or war or volcano or flooding or drought. Such a bad drought in California right now. That could affect you in New York. You know how? A lot of food is grown in California. So if they reduce their growth and their production of food, they can raise food prices here in New York. And that's not good. No one likes to pay more. A hurricane could hit us here. We're not prone. We did get an earthquake a few years ago, but we could more likely get a hurricane. We had one a few years ago. And that can impact the operations of many companies. Just look what happened to the gasoline in the area after that hurricane. Please tell me you remember the hurricane. Okay. So those are examples of event risk that can hit certain companies, and what can you do? There is something you can do. I'll explain it in a minute, though. Market risk. This is the risk of the market itself. So right now, stocks have been going up for the past 2 weeks pretty nicely, right? People are doing well in the virtual stock exchange, and stock prices have been going up. So it's very easy to make money. Just throw your money in any stock, and most everything's going up. So there's no real genius here. Just throw buy, and stocks go up, and you make money. So that's great. However, if the market declines and you're heavily invested in a buy position, oops, you've just lost a lot of money. So, because when the market goes down, all stocks go down. It's sort of like a tide. When the tide comes in, all boats go up. When the tide goes out, all boats go down. Now, you may say, well, you're wrong. Some stocks go up when the market's going down. Yeah, but think of it this way. That stock went up $5 when the market was going down. If the market was going up, that stock could have went up $10. So it went up less than it should have because there's like a gravity. The market could be pulled in a downward or upward direction that affects the returns of all stocks. We'll learn in the next chapter a thing called beta coefficient that measures the amount of gravity a stock has to the change of the stock market risk. So this affects all types of investments and is very difficult to get away from. So the stock market can decline on bad news. And actually, if you subscribe to my YouTube channel, I posted something on will there be a stock market crash in March or April in 2014 that talks a lot about the bad news that can decline the market right now currently. And of course, any economic changes or political upheavals could affect the risk and affect the stock market greatly. So something you can't control. And there's also the risk of currency exchange. This is something that when, say, the emerging markets are having trouble and their currencies are devaluing and going lower, if you're a multinational like P&G and you make a lot of sales in Argentina or Turkey or anywhere in the world where currency valuations are going down and you try to repatriate that money, convert it back into dollars, you have less dollars now. You may have had more sales and more profits in that country, but when you convert those profits back into dollars, you may have significantly less because that currency has been devalued or the dollar has appreciated in value. So when the dollar gets stronger, multinationals return less profits. If the dollar gets weaker, then suddenly the multinationals make more money. So there's a currency exchange risk. And it could affect you as an investor if you invest in a stock directly. If you invested in a Canadian stock last year, or say you invested in September at the height of the Canadian dollar strength, the American dollar strength, that would have maybe the investment really had a zero return, but now it actually has a 10% loss because of the devaluation of the Canadian dollar. All right. I mean, that's common sense for anybody who's dealt with exchanging currencies between countries, if you've ever traveled. Now, you could see how these risks, some of them are, if we look back at these risks, let's go back for a second. These types of risks are non-diversifiable risks. Well, business risk is diversifiable. You can go and you can buy more companies. So you have 30 companies and you diversified the risk of the business failing if you had just invested in that one company. Same thing with financial risk. Having 30 companies will reduce your financial risk rather than having all your money invested in one company. Purchasing power risk, however, is not diversifiable because that affects all companies. Just like interest rate risk affects all companies somewhat equally. So you can't, owning more stocks will not help reduce that risk. Liquidity can be reduced by buying more stocks that are more investments that are liquid or changing the mix of your investments. So definitely liquidity risk is diversifiable risk. The tax risk is not diversifiable because the tax risk is generally applied to all different, any level of income can be hit with the tax risk. So it's not really diversifiable. I mean, you could make an argument that if you put all your money into municipals and won't have to pay tax, that you're immune to any tax changes. But what if they change the tax laws on municipals and now they're being taxed? Event risk is something you can diversify from. So if you have 30 companies, make sure not all 30 companies are located in San Francisco, that you have 30 companies located in geographical areas around the world. So that way, any event in any one area won't affect all your companies. So that is diversifiable. Market risk is not diversifiable. So the risk that markets may go into a bull or bear phase is something that's going to have an influence on all stocks. Just like gravity has an influence of everybody in this room. You don't see anybody floating on the ceiling, do you? Because the gravity affects us all. No one's immune to it. Exchange risk is... I would generally say it's non-diversifiable, but you could say it's diversifiable if you only really invested in domestic companies that didn't have any overseas exposure. All right. So we talked last class. We went over, and I have a video backing up the standard deviation. But we talked about standard deviation, coefficient of variation. So if you missed the previous class where I went over this handout and we calculated it, there's a video on it that will explain it. Now, so basically standard deviation measures the variation of return. So the bigger the variation in return, the more risk of the stock. Now, when you're looking at dispersion or variation, you have to keep in mind the amount of total return. So you could, if the variation was pretty significant, but the stock has returns from 15% to 25 to 30 to 10% to 40%, a lot of variation in there. I still rather be invested in that stock than a stock that's just have consistent returns of 6%, even though the variation is very small. It's between 6 and 6.25. So the coefficient of variation is another statistical measure we could use on top of standard deviation to measure the relative dispersion of the assets' returns in comparison, because we're using the average return as to stabilize the standard deviation by dividing the two. And the higher the numeric value of the standard deviation or the coefficient variation denotes the more risk. And that's how we read that. So if we had, I mean, here's a big chart. If we look at stocks, as far as the return per country, the standard deviation of returns. We have average annual for bonds, and then short-term bonds. You can see that the deviations are some countries much larger than others. So the largest standard deviation may come from, say, I guess this is Finland, might be the largest, and the smallest relatively could be, say, Canada. But what are the average returns of those markets? You would really need that average return to calculate the coefficient of variation to make them comparable. Okay. So let's go back for a second. So these average returns here, the countries with the higher average return would help to mitigate, if they had the same standard deviation, say South Africa and Spain, they're pretty close. Actually, Spain and the United States have the same standard deviation, but Spain has a much higher return at 72% compared to America's 5%. So their coefficient of variation would be lower. So they would be less risky because they have a higher average return. And this was demonstrated in that handout, so I don't need to reiterate this too much. And remember, comprehension in this material helps a great deal if you read the textbook before you listen to the lecture and after. Maybe read it again after. Okay, so risk-return trade-off for various investments. This is just a general scale. If we look at, we say Treasury bonds are risk-free. So this would be the risk-free point. So anything, people used to argue with me about deposit accounts and certificates of deposit. They don't argue with me anymore after that Great Recession where they were threatened and they could easily been defaulted on through bank closures, or and you could lose your money if the bank goes out of business and you had more money in there than the SPIC was insuring you for. They're still relatively safe, but they're not as safe as the government bonds. And then we have corporate bonds, or bonds in general, preferred stock, which is sort of like a hybrid between stock and bonds. We'll learn about them in a future class. Convertible securities, those are bonds that convert to stock. Mutual funds, which are groupings of stocks professionally managed. Real estate and other tangible investments. It's the other tangible investments, like gold, that make this point a lot higher. They probably should have broke out real estate by itself and had tangible investments in one segment, and then real estate would probably be lower on this scale if it was just real estate by itself. Common stock, options, and the most risky futures, which you can't invest in futures. You have to be reach a certain level of professional trading and an organization where it's quite difficult for you to trade future derivatives, but you can trade options. So that's pretty much where your investing life will stop, will be at the options, and that's the top end of the scale as far as risk. And that's risk is there because it's so leveraged. Options are very leveraged, and that's why the risk is higher, because options on stocks are highly leveraged, so they have a higher risk than stocks. Okay, so as far as the risk, the type of person you are and the level of risk depends on the individual investor. Most investors are what we call risk adverse, meaning that you're going to require greater return in exchange for greater risk. That's most investors. Some investors are risk indifferent, which they don't require a change in return to compensate for greater risk. These investors are the ignorant investors who aren't really aware of what's happening, and they don't know when something's becoming riskier that they should require a higher return, or they're just not a good judge of risk-return trade-off. They're just indifferent. They don't care. They don't really follow up with their investments as risks change, and they just, unaware, and they're not looking for any additional compensation. But risk-adverse investors usually do the best, because when risks start to increase, they'll either demand a higher return or move their money into investments that will pay a higher return for the risk levels as they change. Risk-seeking are investors who seek more risk and expect a lower return in exchange for greater risk. That's a really poor investor. So if you're going to take on greater risks but expect a lower return, it's sort of like, why would you do that? Now, in some cases, say in professional sporting, sometimes people will choose more dangerous ski slopes or more aggressive courses because they like that risk because they get a return as far as the accomplishment of climbing a steeper mountain, a more dangerous mountain, or skiing down a more dangerous slope. But in investing, these investors don't last long. All right. And you could see as far as the expected returns, the risk adverse generally will have should require a higher return for the risk than the risk indifferent or the risk seeking. They could accept the same or a lower rate. All right. Okay. So let's combine the risk and return concepts together. So sort of the first step is to estimate your cash flows using the returns and the present values of the returns to get an idea of what your returns are. So the first step really is, what are my actual returns? And to know the calculations to calculate your returns. Then you need to assess the risk of each investment by looking at the historical returns, and you could use a mathematical approach like standard deviation, coefficient of variation to get an idea of the risk, which we measure by dispersion. And then we can evaluate what is the historical returns compared to the historical risks for each of the investments. And then, of course, after we've evaluated the investments we have or investments we can make, then we're going to select the investments that's going to give us the highest returns with the lowest amount of risk. And that's why you have to work so hard, because you really have to look for, first you really have to know what level of risk am I willing to accept, and then you really have to work hard for the right timing or the right investment that's going to give me the most risk, the most return for my risk. Just like if you were going to buy a house, you want to do a lot of shopping, a lot of looking around to find the house that's going to give you the most value for your investment in the house. You know, you could find 10 houses that have the same cost, say $300,000, and then you're going to have to analyze school district versus school district, size of the house versus other size of the house, the location of the property. Is it on a cul-de-sac? Is it on a corner? Is it on a main road? You know, the town, the distance from home, all these factors you can easily imagine you'd have to look into in deciding whether or not to invest in the house. The neighborhood, you know, and that's the same thing with investments. It's just you're not as familiar of all the dimensions to look at as far as risk and return in analyzing a company that you might be with a house, because you've lived in a house, you're very familiar with a home and the advantages and disadvantages of different homes, but you've never really owned or run a company, so you're not as familiar in that arena. That's why I use the house as an example. Okay, so let's just review in Chapter 4 quickly. We talked about the concept of return, the components of return, different ways of calculating return and looking at historical returns, the effect of time value of money on your investments and returns, the definitions of risk-free and required rates of returns in your calculations, your holding period return, you know, what is your return on your investment over multiple periods. We looked over calculating yield and yield growths. We talked about sources of risks and how they could affect stock. And we tried to understand the risk of a single asset, the risk assessment, and the steps of combining risk and return together to make a successful investment. Okay.